Hello, very good evening to the people here and very good morning to the people in the US. It's such a joy to connect with you once again. Sorry I could not connect with you last week. July 15th was the last date for filing the taxes, and the team and we were all occupied. And also thank you very much for all your support for the new iPlan tax program. We're just kind of trying to just revamp this thing. And there's nothing in filing. I mean, you need doctor when you're sick, right? So given the current challenges that we are going through, I think it's very important that not only individuals but also businesses, everybody plan their finances properly. So waiting for the entire year for the W-2 or whatever is your tax statement, and then trying to figure out how you can save taxes after December 31st in the new year, further gone by tax year, I don't think that's a wise action to do. So as part of this iPlan tax program only, every week we are trying to come up with whatever queries we are receiving from the clients. So this week we received query on this qualified small business stock. So this is the query that we have received from our clients on the qualified small business stock. So especially if you are a high net worth client, high net worth individual, or if you are a founder, or if you are an investor, or if you are a very key employee in a company, you must have been issued a qualified small business stock, and section 2002 gain is very, very famous, right? So we will try to take a look at what are the 9 things that somebody should know about this qualified small business stock. So I loved it, and I believe you will also be excited. Okay, and as you're watching this, if you have any thoughts, questions, comments, okay, you can comment in the comment section. I'll reply to you. And there's my email address, Nanda Kumar K V at iLeadTax.com, and that's our number, 530 hi iLead 530-444-5323. So in case you have any personal or business tax situation that you want to discuss with us, this is our number. That's our website, iLeadTax.com. So I encourage you to please get in touch with our team for that 5 to 30 minutes of free consultation, right? So that's why we have named it 530 hi iLead. So enjoy your 5 to 30 minutes of free consultation with our team, right? So let's dive into the topic. So we call it qualified small business stock. Okay, now what is this? This will be little conceptual because it's a very, very dry topic, but I want you to give your utmost attention to this, right? So as you see, what is QSB? Qualified startups and qualified existing businesses that want to expand their operations may raise initial or additional capital through a QSBS offering. So whom is this applicable for? It is for qualified startups and then qualified existing businesses that want to expand their operations. So it's for the new enterprise or somebody who is trying to venture into some new other branches. Okay. Now it says a qualified small business is an active domestic C corporation whose gross assets, mind you, gross assets valued at the original cost do not exceed 50 million on and immediately after its stock issuance. So once you have issued the stock, you have to make sure that the gross assets do not exceed 50 million. Next, the business has to be a C corporation. So people, this is not for everybody, right? You can't be a S corporation or an LLC. However, if you start out as an LLC, then convert to a C corporation, then you could start to qualify on the date of conversion. So I'm sure most of you know. So once you started as an LLC, then you file that form 8832 for that entity classification, and you elect to be treated as a C corporation. Yes, then it is okay, but otherwise it's not okay. It just got to be an S corporation. The next one, it says it also has to be domestic. You can't be incorporated outside of USA. So one of the clients that I was in touch with, he is planning to set up his business outside of USA. So we had to guide the client that this will work out only if the company, if the C corporation is incorporated within USA, not outside of USA. Then, whether you are a founder who gets founder stock, an employee who exercises stock options, or an investor who purchases preferred stock, the assets on the company's balance sheet need to be under 50 million. I think I told you that. So whether you are a founder, you are an investor, or key employee in the company, given the current pandemic, I mean the companies, they try to retain their best talent. So I tell this to my team and also to some high net worth clients who are worried about their jobs and all. When there's scarcity, the quality dominates. I repeat, when there's scarcity, quality dominates, right? So when you are doing something like this, you just have to make sure that it is below 50 million. And employers today are doing their best possible to retain those quality employees. Given the current challenges and all, they're doing their best to retain their quality employees by offering them these kind of small business stock. Now, even intellectual property. So if you are somebody into developing intellectual property, or you consider that also as an asset, yes, that is also considered as an asset. Even intellectual property is considered as an asset. Let's take a look. What does it say? Even intellectual property counts as an asset. If the intellectual property was developed by the company, then the amount of money that they spend to develop it and capitalize it on their books will be the amount of that intellectual property. So with so many people being in the IT industry, people in the IT industry, this is very, very useful for you. So if you are somebody into developing wonderful software programs and all, this is something you may want to consider, right? If the intellectual property was contributed to the company in exchange for the stock, then for the purposes of 50 million asset threshold, you will use the value of the intellectual property upon contribution. See, normally when you're purchasing the stock in a company, you can be paying cash, or you can offer some property in exchange for that stock, or it could also be a payment for the service, right? It could be one of these things. Okay, so the same applies for intellectual property too. Next one, the company must also be an active business. Okay, so it must not be something that is very passively running behind the background. So it must be an active business with 80% or more of its assets used in a qualified trade or business. The idea here is that the company must be an operating business and not an investment vehicle. So you must have seen people saying, hey, incorporate the company there, hey, incorporate company here, okay, that state it gives you this much, Nevada, okay, coming, okay, fine, then Delaware, right? All these other things that they make out. But talk to your tax expert. He will tell you what is right for you. Now, at least 80% of the issuing corporation's assets must be used in the operation of one or more of its qualified trade or business. So just to cut the long story short, the business must be a going concern. It must not just be an investment vehicle, but it should really be an operating business, right? Fine. Having said that, let's check out the next slide here. It says, what businesses, okay? What businesses are covered in QSB, okay? So this is something, very, very interesting. So firms in the technology, I mean, this is the number one thing. Then retail, wholesale and manufacturing sectors. Retail, wholesale and manufacturing sectors. Now, who are not covered here? Okay, so obviously, these industries are already hard hit because of the current, pandemic. And on top of that, they are still not covered. So hospitality industry, hotels, motels, restaurants and personal finance sectors. So even we are not covered, right? The accountants, lawyers, attorneys, right? And of course, farming and mining. Then, now we have been talking about, QSBS and all. Now, what is this QSBS. What is this qualified small business stock? So we have seen here that what is a qualified small business, what must be the business that they must be doing. Now let us see what is this stock, what are the rules and guidelines related to this qualified small business stock. So let's see. A qualified small business stock is any stock acquired from a qualified small business after August 10, 1993. So we have just seen in question number 1 what is a qualified small business, and we have seen in question number 2 what are the different types of businesses. Can everybody get into this issue of qualified small business stock? No. Okay, we have seen who can, who cannot. Okay, now this is something on what is a qualified small business stock. So let's take a look at that. It must be a qualified small business that has issued the stock after August 10, 1993. Now, individuals can receive tax benefits if the investor holds QSBS for at least 5 years. So if you are somebody who has been issued a QSBS, fine. The way I want you to remember 1202, I tell this to my students in the iLead Tax Academy also, 1202, yeah, that's the exclusion. So 1 plus 2 plus 0 plus 2, 5. 5 years. Okay, so 5 years is the holding period. Now, how much of a tax break the investor will receive depends on when they purchase the stock and how long they held it. Obviously, the date you purchased it till the date you hold it, that's the holding period. Next, QSBS is treated favorably for capital gain purposes if both the investor and the company meet certain requirements. I think that's understood. Then investors who sell their QSBS before the end of the required holding period can defer capital gains by investing the proceeds in another company's QSBS. So, in case you have not held it for 5 years and you had to sell it because of the current cash crisis or the current financial challenges that you may be going through. So, in case you got any capital gains, the tax on those capital gains can be deferred if you invested those proceeds in another company's qualified small business stock. A QSBS may also be issued as a form of in-kind payment to compensate employees for their services when cash flow is minimal, I think I told you that, and to retain employees by offering as an incentive to help the company grow and succeed. Given the current challenges, if you have to retain your employees, I think you have to, like the way you are giving the favorable tax treatment for the capital gains IRS, right? I think you should give the favorable treatment for your most productive and qualifying employees, right? QSBS is something that you may want to talk to your employer, right? Next, who can be an investor? Who can be the investor? Okay. Now, to claim the tax benefits of the stock being qualified, the following conditions must be satisfied. Now see, here the individual is a person, right? Is a person. The investor must not be a corporation. So as I said, he must be a natural person. Now see, a company is a legal entity, is a legal person. A corporation is a legal person. But an investor, individual, is a natural person. Okay, so you got to be a natural person. Next one, it says the investor must have acquired the stock, at its original issue and not on the secondary market. So it means what? It means you must be the first time buyer of this stock. You cannot purchase it from an outside market or from somebody else. You got to purchase it directly from the corporation, from the company. Let's say, it says meaning you purchase them directly from the company, or you received them. What does it say? Or you received them directly from the company as compensation and not from another person, right? I think that point is clear. So you must have received it directly from the company but not from another person. And then it says the investor must have purchased the stock. I think this also I have told you. The investor must have purchased the stock with cash or property or accepted it as a payment for the services. Obviously, right? You either give cash or you give property or you give some service, right? When you're contributing something to the business. And last one, the investor must have held the stock for at least 5 years. I think that piece is also covered. Now, let's see, we have been talking so much about this QSBS. Okay, what is the hype? Okay, what is so exciting about this QSBS? Okay, what are the tax benefits that it offers? Let's take a look. Under section 1202, the capital gains from qualified small businesses are exempt from federal taxes. I think that's why we are discussing this topic, right? I mean, increase the refund, reduce the taxes, right? That's why we are discussing this. Now, there are two main benefits of QSBS. Okay, fine. So people who have this, you may want to give more attention to this, okay? There are two main benefits of QSBS. What are they? One, exclusion under section 1202 and rollover. Rollover, right? Exclusion, it means you can exclude all or a part of those capital gains. All or a part of those capital gains. And next one is rollover. I think we discussed that one also, right? So if you sold it before that 5-year tenure, you may defer those capital gains by reinvesting it in another company's QSBS, right? So one is an exclusion, the other one is a rollover. So these are the two main benefits that you may want to look for when you have a qualified small business stock. Fine. Let's see. If upon acquisition of the stock, the company is considered to be a qualified small business, and as an investor you hold the stock for at least 5 years, then upon the sale of that stock, you could exclude from taxation a portion or all of the capital gain. Just told you. Depending on when you got the stock. For example, acquisition of stock typically means being granted restricted stock or exercising their ISO. Of course, for employees it is different, but for you as an investor, it depends on when you actually purchased the stock. That matters the most. Next one. Now, investors who sell their QSBS before the end of the required holding period can defer capital gains by rolling over the proceeds to another company's QSBS within 60 days from the date of sale. Within 60 days. Within 60 days from the date of sale. In case you want to roll that over, right? You want to defer those capital gains, 60 days from the date of sale. That's the timeline, right? Now, how do we calculate this 5-year period? Okay, Nanda, you've been saying 5 years. Okay, you've been beating around it. About this 5-year period now. How do we calculate this 5 years period? Okay, from when to when? Okay, is it from the date of, is it from the grant date, excise date, the date it got, the date it got vested, or date I purchased? I mean, when? From when to when is the holding period, or that 5 years calculated? Okay, so let's check that out. So if you received common stock from the company as a founder or employee or so-called restricted stock, your 5-year counter starts when you receive the shares, right? So if it is something related to restricted stock, it is the date you received the shares. Now, even new stock grant starts a new 5-year counter when you receive those shares. However, stock options do not qualify for the QSBS tax exclusion. You must exercise your stock options. Remember those words, okay? So these are not some fancy words that are highlighted. They are very, very important, right? Please pay attention to those words. You must exercise your stock options, purchase shares from the company, and then hold the shares for 5 years to qualify for the exclusion. What does it say? Exercise, purchase, and hold. 3 keywords. Exercise, purchase, and then hold. Next, the 5-year counter begins at exercise of the option when you actually purchase the shares, not the date your stock option was granted. Hey. You got to pay attention here, right? The 5-year period begins at the date of exercise of the option, not when the stock option was granted. And see the next line. I have to write this. If you ignore this little information about grant date and exercise date, you will end up paying a lot of money in taxes. Oof. Now what is a lot of money for you? It depends on you. Okay. Now last one. The cost to exercise your options is another factor, because you will pay cash now at the exercise price to buy shares, but won't be able to sell your shares for at least 5 years if you want to qualify for QSBS tax treatment. So you're investing the money now, right? You're investing the money now, but are you reaping the benefits of it immediately? No, you got to wait for 5 long years. So that is one more thing, that you may want to consider. Now, how much is the exclusion? Okay, very nice, Nanda. So far, so good. Okay. Now, how much? How much is the exclusion? How much can I exempt my capital gains? Okay. So this much you can exempt. Okay. The PATH Act, means the Protecting Americans from Tax Hikes Act of 2015, allows investors to exclude 100%. How much? 100% of capital gains on qualified small business stock. Now this is something, you may love it, the exclusion amount, right? So it is the higher of, $10 million or 10 times the adjusted basis of the stock, whichever is greater. Whichever is greater. Then, and gains above that amount are subject to, obviously, 25% capital gains tax. Of course, 10 millions, I think, is a decent money, right? So anything above that is certainly subject to the capital gains tax. Now, another point that you may want to consider is even the AMT and the net investment income tax. This may also be applicable. Okay, AMT and then net investment income tax. Okay, now I want you to please pay attention to this table. Please take a look at this table, right? So it says that if QSBS is acquired in after, these are the dates. Okay, the first column you see, these are the dates, are acquired after September 27, 2010, 100% of capital gains are exempt. 100%. Okay. Of course, subject to that 10 million. And then AMT and NIIT, right, net investment income tax, that's also excluded. In case these shares are purchased between Feb 18, 2009 and September 27, 2010, then 75% of capital gains are exempt, and 7% of the gain is subject to AMT, right, is subject to AMT. And then last one, if it's acquired between August 11th and Feb 17th, then 50% of capital gains. And then, 7% that continues AMT. So, can't do anything on that. That's the best, that you can get out of this deal. Yeah. Now, how is this computed? Okay, here, we have tried putting a small example here to show you, how it's computed. Okay, so let's take a look at this. So, if someone has invested 2 million, let's say, okay, in a qualified corporation on 15/2012, and he held that investment for 5 years, then they could sell their QSBS for up to 22 million. Hey, how come? How come, right? What is the exclusion amount? 10 millions or 10 times the investment. 10 million or 10 times the investment, whichever is higher. And what is exempt? It is not the sale proceeds that is exempt. It is the capital gains that's exempt. And how do you calculate the capital gains? Selling price minus the cost price, right? So take a look. That's how the 22 is calculated. 10 times the 2 million, the initial investment, plus the initial investment 2 million. So it comes to 22 million. So without owing any capital gains tax. And once they deduct their initial investment, they have 20 million tax, which is not taxable on their federal income tax return. And next one. Similarly, an investor who put 500,000 into the same corporation would be able to sell their shares for up to 10.5 million. Same. Why 10.5 million? Why 10.5 million? 10 times the initial investment or 10 million, whichever is higher. Now, 10 times of 500,000 is going to be what? 5 million, right? So 5 million or 10 million, whichever is higher. Of course, to that 10 million, you will be adding that initial investment of $500,000, right? So 10.5 million with no tax on the capital gain of that 10 million. However, if the investor's proceeds from the sale total 15 million, now in case he sells this for 15 million, right? Then he will have to pay a 28% capital gains tax on that additional 5 million gain. If you need more time to a pen and paper to just work out these calculations, you may please watch this again. Fine. So this is an example on how that exclusion is calculated. Now coming to the state taxes. Now, do all states offer exclusion? Okay, Nanda, federal taxes, okay, cool, good. Now, do all states offer exclusion? Many states, they follow the federal tax treatment, but there are some states which do not follow. Okay, let's take a look at this. So, as you see, many states follow the federal tax treatment of QSBS, or they don't have a state income tax, but there are important exceptions. Now, California doesn't offer a QSBS tax exclusion. Friends in California, clients there, right? Doesn't offer a QSBS tax exclusion. Then small business stock sales are fully taxable in California. So already a high tax rate state. Then next, Pennsylvania also doesn't offer a QSBS tax exclusion. Of course, Massachusetts, New Jersey and Hawaii offer a QSBS exclusion with some modification to the federal requirements. So if you are somebody in these states and if you are looking for that QSBS planning, just schedule a 5 to 30 minutes session with us, a free complimentary consultation with us, right? Remember our number 530 hi iLead. It's so easy to remember, 530. Tell yourself that 5 to 30 minutes of conversation with us is definitely going to add value for you, right? And last, what if there are losses? Okay, we have been talking only about profits. Now what if we have loss? Do losses also have some favorable tax treatment? Okay, capital losses, let's take a look at that. Losses on small C corporation stock can be treated as ordinary loss up to $50,000 per year. What do you mean by ordinary loss? It means you can set it off against your regular income, your ordinary income. You don't need necessarily a passive income to set off that loss, right? That's the good news. Now this is as per section 1244. Now there is a condition. The company should have a total paid in capital of 1 million or less. Of course, we remember that less than 50 million gross assets rule and all. But here it says that the paid up capital of the company must be 1 million or less. Now, so this is something I had to write so that if you are somebody who is issued a QSBS or who is investing into a QSBS, you have come a very long way. I respect the challenges you must have gone through, right? So To handle that, I think you need an expert. Okay, so I had to put these lines here. So if you think you have a stock that may be a QSBS, consider consulting with an experienced tax attorney or a CPA or an enrolled agent or a financial planner who is knowledgeable about QSBS. Experienced and knowledgeable. Now, if your stock doesn't qualify for QSBS tax treatment, check their tax treatment for non-qualified stock options and incentive stock options. So if you feel they are not QSBS, just check if they are non-qualified stock options or incentive stock options, and if they need any special tax treatment. And I encourage you to have a complimentary consultation with us to discuss your personal tax situation. You have our contact number and our email address written there, and I encourage you to schedule a free consultation with us. Given the current pandemic and people losing jobs, and that's one side of the story, but as an accountant we get to see the prosperity side also, the innovation side also. There are people who come up with wonderful ideas, so they discuss with us. They want to start new businesses. Okay, Nanda, which one is the best entity for us? Should we do a LLC? The clients who are watching us, I'm just talking about you, right? Is LLC good for me? I'm still on my 1099. Do you think I should form an S Corp or an LLC or a C Corp, right? What is the best I should do? Okay, this is the business that I'm starting. How do I do this? Okay, we are not talking about W2 and the regular stuff. Go beyond, right? So with that in mind, we happen to launch something called as iPlan tax program. So we say, stop filing yearly, start planning monthly. Start planning monthly. That's something you may want to consider, right? It's enough. And you've been doing the same mundane thing so far. So these are the 10 services, and the best thing is that it is recommended as an employee benefits program also by many companies. So thank you very much that the employers, that the decision makers, the finance heads, you understand the importance of planning and not just filing, right? So filing, even the online portals can do. So these are the 10 services that we offer as part of our iPlan tax program. So I encourage you to make a note of this. I think now it's visible. Yeah. So I encourage you to make a note of this. So here you get all these 10 services, right? You get the planning. Now, if you have not read that one line, I want you to read that again. Okay, what is that? Get your 2020 federal, state and local tax filing for free. Hey. And most of our clients, they also have income in India. And if you're watching this video, and you're calling our office, I want to give you the Indian tax filing also for free for next financial year. Okay, so why wait? So please call our office and enroll for this iPlan tax program today. It offers you the federal, state and local tax filing for free. Also the FBAR and FATCA, I'm sure you must be aware. If your friends or your little research has still not told you what is FBAR and FATCA, I want you to give some thought to that, right? And then free ITN application assistance. So if you have somebody who is not in employment, right, especially your spouse, non-working spouse or dependents, you may want to consider that. And then ever since the TCJA Act was instated, the Tax Cuts and Jobs Act, ever since Mr. Trump has been in existence, there has been so many changes to the tax reforms, right, from the 21% tax rate to doubling the standard deduction and taking off the exemptions and so many things. So if you want us to evaluate your last 3 years tax return to check for some additional refund possibilities, or to ensure that you're compliant with the IRS, we would love to do it for free for you for the last 3 years, right, just as part of this iPlan tax program. And then, as I said, you get the Indian tax filing also for free, of course the extension filing also, and then the error-free tax representation guarantee for audits or notices. So if you have more questions on this, I encourage you to please write to us. I'm Nanda Kumar KV at iLeadTax.com. Okay, and whatever, I hope you enjoyed today's content on qualified small business stock. So if you want me to make videos on any other topic that you might be interested in, please write to me at Nanda Kumar KV at iLeadTax.com. And if you want to schedule a complimentary consultation on any personal or business tax matter, please text or call us on 530-HI-iLead, 530-444-5323. Our tax experts, enrolled agents, they'll love to serve you, right? Thank you very much for joining us today, and if you like this video, please do share it with your loved ones. Yeah, it's been such a joy interacting with you all, and thank you very much. And please do like our Facebook page, and also please do subscribe to our YouTube channel. You will get, I think, the real-time content. I mean, the real tax situations that's boggling in the industry, in the minds of our regular taxpayers, whether personal or business clients. You will get to learn so much. Fine. Let us know how we can make this a little better. And until we catch up next time, bye-bye. Take care.